All right, so finally we'll look at preferred stock. What is it and how does it impact stock? First, as we've mentioned in this course, it's a hybrid security because it has attributes of like a bond where it has a regular payment. It has attributes like a stock because it does trade, it does have value going up and down, and it's often convertible to equity. So there's definitely characteristics that lean toward stock and some that lean toward debt. And so because of this issue, we want to get rid of it, right? We want to have the value of the enterprise and subtract out all the debt and subtract out the equity. So it's very difficult to value preferred shares because each of those have very specific and differing types of provisions. But a simplistic way is to say, treat it as if it were um, a perpetual dividend with no growth. So if we take the dividend amount and divide it by a required return for preferred stock, we would get the value of preferred stock. So as an example here on the very bottom, the dividend is 210. The required return on preferred stock of this preferred stock is 7, and therefore the price is 30. Right? Again, it's just an approximation because preferred stock varies from one to the other, and it could be quite dramatic. All right, so summarizing chapter 7, we're doing valuations. And first, there are many variations, types of common stocks. They all have one class, but they may have multiple classes. They might even have tracking stock. And one way to look at this in terms of translating the value is that we have liabilities, assets minus liabilities minus preferred stock equals common equity value. And the three methods we've looked at in this chapter are free cash flow, from fairly simple ones where we are given free cash flow, to some with varying free cash flows, to then using projections. We then looked at dividend discount model, again, from very simplistic with no growth, to constant growth, to multi-stage growth, to kind of uneven growth. And finally, we looked at multiples, simplest of all, which is to benchmark one company where you do not have a market value to other companies that are similar that do have market capitalizations or market values. And from those relationships for the subject company, apply it back to your company and get an estimate. Preferred stock is this hybrid entity that has characteristics like debt and common stock. And usually in valuation, we want to eliminate that from the value so that the only thing that's left is residual value. Residual value after we take care of everybody. Operating expenses, assets, paying off our debt, and paying off our preferred shareholders. The rest belong to common shareholders, and therefore we can get to a price per share. And that's it. I wish it were that easy for us to do one, two, or all three methods and derive the proper stock price for every publicly traded stock in the exchange. I'll see you guys in class. Thank you. Bye.